Bring in Wharton School professor and Wisdom Tree senior economist Jeremy Siegel. Professor, welcome back. It's nice to see you in this new year.
Good afternoon, Scott.
What do you make of the market's reaction today to that better than expected jobs report and the move in rates?
Well, the price in stocks is always a battle between the numerator and the denominator. The numerator is earnings, and the strong, it's a strong report, and that's good for earnings. But it also, strong report also means higher interest rates. That's the denominator. Today, the denominator beat the numerator. I think really the market is saying maybe no rate cuts in 2025, and that the 10-year could very easily break well above 5%. One has to realize, I've done the historical research, over the last half century, the long rate has been on average between 1 and 1.5 percentage points above the Fed funds rate. We have a Fed funds rate now at 4.3%. So, do the math. You're talking about 5.5, 5.75 potentially on the 10-year, and that's a normal term structure. That's not anything that's unusual. And I think we got so used to this inverted curve, with the short above the long, we thought the long would stay low, but that is not normal through history. So now I think what investors have to say is, oh my goodness, all right, if the 10-year goes into the fives, earnings are going to be good, but I have to take that into account.
Are you thinking that the Fed might not cut anymore? I know you said the market might be thinking that. Does that match with your own view? And do you really think that the 10-year could get substantially over 5%? I
think it could. I think no one really, anything could happen, when we talk about 3, 6, 9, 12 months out. Clearly, if things start slipping, the Fed will lower. But given the growth that we see right now under that, and if you take a look at the futures and adjust them for risk premiums as I do, I really see that virtually every cut has really been wiped out. And looking at history, I was saying that is actually a formula for higher long-term rates. And as you know, before year end, I said that this could be the year of a correction. I don't think it's going to be a big collapse. Look at the VIX. I think crossed 20 today. It's a little bit lower now. That's a lot of hedging in the market. There's a lot of people that say, oh my goodness, this could be a little bit of a dip. But when you get VIX at 20, I don't see a big fall. But I think the thought that I have to deal with maybe a 5 to 5.5% long bond. How do I allocate in that case? And especially for all types of stocks. Small stocks are hurt because if the Fed doesn't cut, their interest costs remain high. The tech stocks don't borrow at those interest rates, but they have to worry about discounting. And since they're, such high PE ratios, a small change in discounting send them lower. So both those have, for different reasons, been depressed by the strong economic growth. By the way, no one mentioned today that the wages came in at or actually below expectation. So, it wasn't a wage pressure situation over here. It was really, wow, this economy moves ahead at this interest rate. Is that R star, or what we call that natural rate? It's really, we're very, very close to that now, maybe just a tiny bit restrictive, if at all.
Well, you did have UMich inflation expectations rise, which maybe just added a little bit of fuel to all this. Let me ask you this. What weighs more on the proverbial scale, if you will? Tax cuts and deregulation and good feeling about the new administration and what it means for the economy, or higher rates, thus fewer cuts? Can the market overcome the latter?
Well, as we mentioned before, remember, the big tax cuts were done in the last Trump administration. The ones that are talked about now are much smaller. I mean, even if he can get 15, and he's talked about 15% for domestically produced, I mean, compare that from going down from 35 for everyone down to 21. So, I mean, people are saying it's a repeat, but it isn't. It's on a much smaller scale. Also, he got a lot of deregulation done. Now, unfortunately, Biden put some of it back, but a lot of it was done. I don't think, are we going to get the increment again that we got in his first term? So, in my opinion, those boosts, and they are positive, I don't think can overwhelm what might happen to interest rates to keep this market much flatter than we've seen it for 2 years.
Yeah, you mentioned the possibility of a correction. Would you be a buyer of it?
Yeah, I mean, if we get down 10%, I say on the S&P, which would probably mean 15 to 20 on I would put idle cash to work definitely on that. I do not see a bear market. Which is over 20%, although certainly there's the technical traders can bring it there. But I think you would be rewarded by buying below the 10% mark.
What would you do with the Russell? I mean, the pullback, looking on my screen right now, I mean, the Russell over a month is down 8%. It's obviously the first place you look. I know people want to look at growth stocks, et cetera, but when rates rise, the Russell's been in trouble.
The Russell is totally a story about wiping out those Fed rate cuts, because those small stocks do borrow at the Fed rate, overwhelmingly, and which, of course, large stocks really don't. So, I mean, all their borrowing costs, which were being factored in, is going down 20%, 30%, 40% in terms of that. That just might not happen. So that's going to hurt their bottom line, and that's the problem with the Russell 2000. So once it gets used to the fact, hey, maybe we won't have any rate cuts, I mean, you take a look at their valuation, say, hey, I can sit on them at this particular level because valuations at 12, 13, 14, 15 times earnings historically have been rewarding to investors.
I mean, I know we're talking about the Russell, and sometimes we use it as a proxy for the so-called broadening trade. But the broadening trade does have a problem if rates remain where they are, if not back up even further, correct?
Oh, yeah, absolutely. Well, don't forget, I mean, there's two things. There's the value growth, and then there's the small stock. Now, most of the small stocks, although we divide them in the value growth, many of them are more of those value stocks. So both of the value story and even among the big stocks, which have dividend yields, which are challenged by the interest rates, and the small stocks, which have interest costs, which are challenged by the lack of interest rates, they both suffer, and they have both suffered. And the AI narrative, now you talked about Apple and what might happen there. The AI narrative is still intact, and there's no real trend break of the growth stocks relative to the value stocks or the Mag 7. There's really not yet any sort of major trend break. So that's one of the longest established trends, and that train is still going at this point.
All right, we'll leave it there. Good weekend to you, Professor. We'll see you soon, I'm sure of that. Professor Jeremy Siegel at the Wharton School. We do have some news.
Welcome back to Overtime. Stocks closing sharply lower after a hotter than expected December jobs report and a jump in inflation expectations. 10-year yield surging to its highest level since late 2023. Let's bring in Allianz Chief Economic Advisor Mohamed El-Erian. Mohamed, good to see you. So you combine those inflation expectations with the hot jobs report. What has to happen for this to be good, say, for an S&P that's already trading at a historically high multiple?
So first, it is good that the economy is doing well, John. We must not lose sight of the fact that U.S. economic exceptionalism provides the only locomotive of growth for the global economy. So as disrupted as markets may be, because this was a hot employment report, the alternative of a weak one would be much worse news for not just the U.S., but around the world. In terms of what it means for investors, investors are going to be increasingly pushed into a barbell, looking for high quality yield over here and being more opportunistic over here and more agile, including going to private markets. I think that what you're seeing is this transition from market-based investing to theme-based investing, and now it's going to be much more individual names.
Okay. Well, now also that we have this jobs report behind us, attention's going to turn to earnings, but we've got the strong dollar. So for multinationals in particular, how's that going to affect guidance?
Yeah, and we also have an inflation report coming up next week, as you discussed earlier. Look, analysts right now have to take seriously that the dollar index is almost at 110, the euro is almost at parity, and that is going to impact multinationals. And they should take that into account, and it's going to be a headwind to U.S. denominated earnings from abroad, and just the reality of U.S. outperforming the rest of the world.
Mohammed, I'm going to ask you a question I asked Bob Elliott earlier, and that is, are the bond vigilantes back in this market? And by the way, not just here in the U.S., but globally, especially when we look at what's been happening in the U.K., for example.
They're definitely back globally. And what you see in the UK is that very strange combination of them having had higher increases in yields than us, and yet their currency has weakened significantly. That combination of high yields and weak currency, you typically see more in an emerging economy where bond vigilantes are much more active. So yes, they are back. I think what we are having here, Morgan, is not as much the bond vigilante, as much the reality of three things. One is growth is stronger than anticipated. Two is inflation is stickier than anticipated. And three, we have the reality of high deficit and high debt.
I want to get your thoughts on this quiet climb we've seen in crude oil in recent weeks. Energy stocks are actually the best performing sector to start this year after being the worst performing in the S&P last year. But oil in general has been moving higher, maybe part of it's sanctions, but is it sustainable?
Yeah, I mean, you got a 3% move today. You've had a 10% move over the last few weeks. This is significant, and it adds to the inflationary pressures. The one today is purely in terms of sanctions on Russia that the market believes will be much firmer this time around than they've been in the past. So you're looking at a supply side issue. And the big question for is whether OPEC Plus OPEC in particular, because the plus side is Russia, but OPEC and Saudi Arabia in particular will want to increase production. But this is all supply side. It is not a demand issue, it's a supply issue.
A lot of cross currents for investors to navigate right now. Mohammed El-Arian, thanks for joining us.
Thank you.
Throw earnings into the mix starting next week. It's time now for a CNBC News Update with Deirdre Bosa. Hi, Dee.
Hey, Morgan. Amazon is just the latest company to roll back some of its diversity and inclusion programs. Amazon's announcement follows a similar move by Meta earlier today and joins a wave of companies reversing plans for DEI programs such as Walmart, John Deere, and Ford. Meanwhile, a majority of the U.S. intelligence community found no evidence that foreign powers were to blame for the mysterious Havana syndrome incidents reported by some government employees. But in a new assessment released today, two intelligence agencies, which were not identified, said it was possible a foreign power could have developed or even used a weapon to cause the incidents that first appeared in Cuba in 2016. And more than 150,000 doctors have signed a letter urging senators not to confirm Robert F. Kennedy Jr. as President-elect Trump's Secretary for Health and Human Services. That's in a letter posted online. The doctors said Kennedy's well-documented promotion of false medical claims made him dangerous for the position. Back over to you guys.
President-elect Trump expressed an interest in acquiring Greenland during his first administration. And as he gets set to settle back into the White House, his interest in the world's largest island is heating up again. Pippa Stevens looks at why Greenland is so important to Trump and to this conversation around the U.S.
Hey, Morgan. Well, President-elect Trump is eyeing Greenland for three key reasons: rich mineral resources, access to valuable shipping routes, and strategically important location, especially as Russia and China ramp up their operations in the Arctic and as tensions with those two countries flare. Now, drilling down a little bit, Greenland has 25 of the 34 minerals deemed critical by the EU. That includes lithium, graphite, and copper. Those are vital, of course, for iPhones, electric vehicle batteries. Greenland also has a large deposit of rare earths, which are really important for everything from wind turbines to military equipment and computer chips, and China currently dominates that market. Now, the Arctic ice is melting, meaning that shipping routes around Greenland are becoming more accessible, significantly cutting transit times and costs. The two key ones to watch are the Northwest Passage, that is the orange line there, as well as the Trans-Arctic route, that is the purple line. And as you can see, it really cuts down on the time and the cost of going all the way around. You also avoid bottlenecks like the Panama Canal. And finally, the location is really important. The U.S. has had a base in Greenland since the 1940s, and it currently operates the Pitufik Space Base up there in the northwest of Greenland. It includes things like missile defense and space monitoring. And with Russia and China increasing their operations in the area, the ongoing U.S. access, Morgan and John, is really what's key here.
Yeah, and from a military defense, national security perspective, when you're talking about ballistic missile defense and early warning systems, it's absolutely crucial, our footprint there and being able to monitor the airspace there and the space there as well for the future. So certainly there's a conversation to be had about what military presence from a U.S. standpoint looks like in Greenland moving forward. But I want to go back to the rare earths piece of this, because I realize we have an Earth that is warming in temperature. You're starting to see some of those glacial masses melt in a more meaningful way. So when we talk about rare earths and extraction of rare earths in a place like Greenland, is that even on the table now because of that?
Well, so far they are not extracting anything, and certainly at nowhere near commercial scale. They did have two mines in operation for rubies and a northesite, which are not critical elements. A northesite is found in things like paint and glass. And so while there are all of these hopes that there could be one day this massive extraction effort, to date there hasn't been, and it's really, really hard. They only have 56,000 people. They don't have the workforce. If you want to have a mining operation, you would have to bring in skilled labor from elsewhere. Not really open to that at this point. And also, they are very aware of not having their resources plundered by other countries. And so when the natives of Greenland look to what their future looks like, I think they want to bring in companies that are thoughtful about their extraction methods. However, they have really been targeted as a key area, and we've seen Bill Gates and Jeff Bezos, among others, backing a company called Cobalt Materials, which is just one of the companies that's exploring in Greenland. So for the time being, Morgan, a lot of hope, but so far nothing is actually coming out of the, more than 80% ice that covers Greenland.
All right. Pippa Stevens, thank you.